Okay, welcome everybody to Kathy Fettke's mid-year real estate market update. My name's Blair. I'm with Think Realty. Thanks so much for joining us. First off, before we hand it over to Kathy, I just wanted to remind everybody that our Think Realty Baltimore conference and expo is coming up. It's going to be a hybrid conference and expo. So that means that we have both in-person and virtual tickets available. It's September 18th and 19th. It's going to be a great event. We're going to have over 200 top tier real estate professionals there, a cocktail reception. We're going to have over 30 exhibitors. We're going to have all of our resident experts there. So definitely join us if you're able to, either virtually or in person. And you can get tickets at thinkrealty.com/Baltimore. That's thinkrealty.com/Baltimore. And yeah, so we hope to see you there. And right now, I'm going to hand it over to Kathy. She's going to be speaking to you about what real estate investors can expect in the coming months, along with what experts are saying about the future. So it's going to be a great topic. So without further ado, let's hand it over to Kathy Fettke with Real Wealth. Thanks so much.
Oh, thanks so much for having me. And your events are always top notch. They're always
thanks.
Really, really great people in the audience and great people on the panel. So, all right. Well, I will then try to share my screen and let's see how I do on that. I think it's there.
There you go.
Okay. And then I'm going to put it in play mode. Did that work? Yay. Okay. You can see it, right?
Yeah, it looks good.
Okay. You can see the screen because you can see the disclaimer?
Yep. We're all good.
Okay. Okay, good. All right. So I'm Kathy Fettke, co-CEO of Real Wealth Network, and I'm going to be giving you my opinions and, these are my opinions. So just take what you want, use the data that I give you and do your own research. Just, talk to your CPA and attorney to see how this applies to you. All right. So to give a little bit of background, I know some people might know who I am and some people don't know maybe my story, but back in 2003, before we were really in real estate, but we had just bought our own house and Rich got diagnosed. My partner, my husband, Rich got diagnosed with melanoma and the doctor told him he might have 3 to 6 months to live. Rich is alive and well today and he had it all cut out and he's better, but they thought it had spread to his liver. Fortunately, he's fine with regular checkups, but at the time we didn't know. And this is pretty normal, right? Especially these days of unexpected bills and unexpected things tapping into your emergency funds. And that's where we were. We didn't have passive income. We were on a just eat what you kill, I guess, plan where, constantly having to sell and working on an hourly rate. So we didn't understand the passive income concept at the time. And we pretty much blew through our savings and our retirement funds and our emergency funds over these medical bills. And I know that many of you can relate to this, whether it's medical or other expenses that, best laid plans get derailed sometimes. And that's what happened to us. So we had bought this house. We also did the typical American thing back in 2003 and way over leveraged. So we got this big house. It was over 4,000 square feet. It was a $4,000 or $4,500 a month payment. And back then so this is a long time ago, right? 17 years. So that would kind of feel like a $9,000 payment today that, based on inflation, it was a lot for me to, we were just barely getting by. And then when Rich was told he had maybe 6 months to live, well, he wasn't going to live those 6 months working. So he took the time off to do, to spend time with the kids and take care of himself. And I had to figure out how to make that money to cover this bill. So that's when I became a real estate investor kind of by accident. And we rented out these lower units of the house. So sometimes maybe over leveraging and going too big is not the worst thing in the world because we had such a big house that we were able to carve it out and turn the little in-law suite below on the left here into a unit. We rented for $1,200 a month. And then to the right, a little studio. And that was again, around $1,200 a month. And then this little back room behind the house. These were all kind of separate entrances where we put little kitchenettes in and kind of sealed off the doors so they couldn't come into our main house upstairs. But we just kind of turned this thing actually into a triplex, but even a fourplex at times, and rented it out on Craigslist. Didn't know what we were doing, but it got us through these difficult times. And that is what got me hooked. Now, at the time I had been in the news business. I had worked at Fox and ABC7 and CNN for my early career. I quit to raise the kids and be a stay-at-home mom, but I also had this little side radio job at KNEW in San Francisco, or it was KNEW when I first started. And I had just been doing like daily news clips and kind of my thoughts on it, commentary and so forth. But I quickly changed the whole content of my show to how do I make money? And more importantly, how do I do it in real estate? So I'm giving you this background to just help you understand why I feel like I can help forecast what's coming next. Because of this mission I had, and it's of course the Real Wealth Show today, it's a podcast today. At the time, it was just a radio show in San Francisco. It was my mission to understand, how do I create passive income so I can continue to be a stay-at-home mom, continue to live the way I wanted to, take care of my husband during this difficult time. So, the bottom line is, when you immerse yourself in learning, you find out how other people have been able to do it. And that's why the Think Realty conference is so valuable. You get to meet those kind of people. Well, I got to have Robert Kiyosaki on the show in 2005. And that's when his advice really changed our lives and our trajectory. And it's what I'm going to be sharing with you today. And if you can believe that 16 years later, it still applies. I'm sure a lot of people here today have read the Purple Book and understand the advice, but it was really like, when it comes to real estate, buy for cash flow. And as a California resident, I didn't even know what that word meant. We didn't have cash flow in California. So that's when he, on my show, live on my Real Wealth show, he said, California has really gone up in value. It's actually doubled in value over the last few years because of those crazy loans. He said, those loans are going to adjust in 2007. That was well documented. People knew that. I don't know why it wasn't widely known, but investors who understood when these loans were going to reset knew there would be a recession coming. So he was very proactive in getting out of all the bubble markets and into the markets that were not in a bubble. How did he know? Well, and so he basically explained, he sold all his California property in Florida and Arizona, and he was buying in Texas. Why Texas? He explained it was where the jobs were going. It's where the population was growing. Those two very important components, population and jobs and affordability. So when you get those three together, that's the magic. You've got growth and yet, affordable properties that people can afford to rent. So Rich and I were like, hey, if it's good enough for Kiyosaki, it's good enough for us. We ended up buying like 8 homes in Texas. It was really easy to get loans there. That was really the problem, right? Is I could literally buy these 8 homes with no money down and interest only loans. And we did. We were like, hey, we'll fill out the paperwork and buy them. They were $120,000 to $140,000 homes that rented for $1,500 a month. So it just made sense to us. I talked about it on the show. We got flooded with calls from people saying, hey, I want to do the same thing. And that's when we started Real Wealth Network. This was our first website. And it was really just a place for investors to come together and figure this thing out. Like, how are we going to get out of what appears to be a coming storm? And how do we navigate that? Well, it turns out those homes in Texas have tripled, quadrupled in value since then. They never dipped. They stayed rented. And it was really wise advice from Kiyosaki to buy for cash flow in growing markets. Then the 2008, the Great Recession hit, just like he thought it would, because those loans were going to reset and there was no way people were going to be able to pay those payments. They never qualified in the first place. I knew firsthand because I'd become a mortgage broker at that time. And again, these Texas properties did fine. And we learned cash flow is king. That is the big thing we learned from that massive housing recession, that the people who listened to us at Real Wealth and did what we did and used our teams and the property managers, they really came through that crisis pretty well. Unless they did some of the things we did, which is we held some California properties that lost millions of dollars. There were some really big mistakes we made too, because we didn't take this advice of following the cash flow. We were kind of speculating in other markets, and that didn't work out well. But as a company in 2009, okay, all of a sudden there were all these foreclosures. So we brought busloads of people into these markets that were recovering, but they were also had population growth and job growth. And we went and brought busloads of people to buy the foreclosures and fix them up and return those neighborhoods to the condition that they had been in before they were boarded up. And because of that, we got recognized by Goldman Sachs as one of the top most intriguing entrepreneurs. We were at this event in 2012 with the founders of Uber and Airbnb and some really big names. It was a huge honor. And it was really simply because of this, being able to see what's coming and react appropriately. That got me onto a debate on Fox News with Robert Schiller, who said, here he's Robert Schiller, right? Our debate was, he thought 2013, it was a terrible time to buy real estate, dangerous, he even said. And I was like, that's not true. Interest rates are at all-time lows. Housing prices are at all-time lows. You can get stuff for almost nothing. In some cases, 10% of what their former value was. How could that be dangerous? And by the end of the interview, he agreed with me. The reason I state this is that sometimes even the biggest names, even the people that you would think would be able to give you the right advice, sometimes aren't looking at the same data. He might have been sitting looking at raw data, which is charts showing prices going down. And that was true. But when you look at it like, well, what's coming? Well, we've hit bottom and it's going to go back up and it's cheap and there's cash flow. And that's not really what he was focused on. So because I kind of won that debate, that got me a bunch more interviews and here on Think Realty. So I just wanted to give that background to kind of explain what I think is happening now, because many people are thinking, are we there again? Is this another 2009? Or really it would be more like 2006 when it peaked. Then things started to kind of slow down in 2007 and then just crashed in 2008. So I think a lot of people are wondering, are we there again? Have we bubbled and should we be concerned? And these are the kind of headlines you're going to see from people who don't really know. These are reporters who don't understand the market enough to be able to, comment, but these are the kind of headlines that get eyeballs and that sell advertising. And so you're going to see a lot of it. When you see this type of thing in June of 2021, home prices across the US surged 24% year over year. Well, that's terrifying, isn't it? That's a big number, and that's not a sustainable number, and that has people freaking out. And during the same time period, the number of homes sold increased 20%, and the number of homes for sale tumbled 39%. I mean, just incredible, right? So it is like scary to wonder what is next. Well, I'm going to show you some slides that might help resolve that. We look at this and we say median single family home price to income. It's really high right now. The price of a house compared to income is up there. And this is nationally, so every market's different, but it's definitely gone up. We know that prices have gone up. But what's interesting is that mortgage debt to income has gone down. So what's happening here? Prices are going up, but payments aren't. So a lot of the mortgage payments are not that different from 5 years ago, 10 years ago, even though the home price has gone up. Now, if there was a decrease in prices, but people could still afford the payment, would they just walk away from that home like they did last time? Not likely. And let me explain why. The people who are in the housing market today are very different than the ones that were in the market when I was there. When I was a mortgage broker in the 2000s, we could literally give a loan to anyone. I didn't need any documentation or backup. You just filled out an application, maybe pulled a credit report, maybe not, and you could get a loan. So it was really easy money, literally loans for anyone. And we could do it up to $5 million. So free money, basically, who's not going to take advantage of that? But then when the loans came due, of course, then that's when it all fell apart. We do not have that situation today. We have very high FICOs. Look at this, mortgage originations by credit score. And you've got 760, that blue line, 760 plus credit scores. These are very qualified people with very strong borrow profiles, low debt to income. Look at their debt to income ratios have gone down. That means they have less debt. A lot of people believe that's because of the government stimulus over the past year, helped people pay down their debt. So their balance sheets are looking amazing. The median single family home price to income These people are sitting on so much equity. So not only do they qualify for the original payment, but now the value of the house has gone up. This is not the same scenario as before. So, and then there's this concern, well, there's going to be this flood of foreclosures and that will rock the house. Well, there were some headlines that really were freaky and scary last year. And that is 5 million homes going into foreclosure. It was misleading because there were millions of people who signed up for forbearance programs, but many of them never even used the forbearance. It wasn't going to affect their credit. So people signed up because they didn't know what was going to happen to our world. They signed up, but many of them never even used it. And then many exited successfully. Some got loan modifications, some had payment plans, but most people exited successfully. But there were there's still some who did not basically aren't able to pay. So we've got here, you can see 27% loan deferral, 24% borrowers continue to make their payments, 15% borrowers who did not make all of their payments and exited without a plan. So what's the plan for those people? Let's say there's 400,000 who left. That's about what it is, without a plan. So these people could go into foreclosure. Here's the scenarios that people were thinking would rock this whole strong, bullish housing market. Number one, let's just say that all of those people put their houses on the market all at once. Now, remember, a lot of these homes have equity. So, they're not going to just hand them over to the bank. They're going to sell them. It would take 25 days to go through that inventory because inventory levels are so low. If only a third of them were listed, that's 133,000 homes. It would take 8 days for those to reduce the inventory or to add to the inventory. And then scenario 3, 2/3 listed, again, 17 days. So this isn't going to have an impact. I should say it would have an impact, but a good one, because there's such a desperate need for housing that anything that, kind of helps increase inventory levels is actually a good thing right now. So to kind of put that behind us, that it's a very different market. These are strong borrowers. Many of them put big down payments down, maybe paid completely in cash, qualified for the loans. They have good jobs, good track record. There was full documentation on the loans as opposed to like just no documentation when I was doing it. So kind of put that behind us and say, these are good, solid borrowers in today's market with lots of equity. If we go back to the benefits of real estate investing in general, what we know is we have the ability to borrow 80%, even sometimes more than that, to acquire an asset that we own 100% of. And then we bring in tenants who will pay that 80% loan off for us. And there's extra money after that to cover expenses and so forth, and even to put in our pocket or reinvest that cash flow. So you borrow the money, you get 100% of the write-offs, of the equity gain, and of the cash flow. That's amazing. And then someone else pays that loan off for you. Then you've most likely got appreciation, which I'll explain why that's probably going to continue for a while. And then tax benefits, which some people are concerned we will be losing, but I'm going to show you in a few slides, it's probably not as bad as you think. And then asset protection. So these are really the benefits of owning, regardless of where things are headed in the economy. What we know is when it comes to leverage, that's one of the big things. We have record low interest rates. It's an incredible time to borrow money at 3-4% and invest it at 5, 6, 7, or 10%, right? That's good investing. We have rising rents. That's wonderful if you're looking for cash flow. We have home price appreciation, increases your wealth. And we still have amazing tax deductions. We've got, you can write off your mortgage interest, your insurance, your legal, your accounting fees, depreciation is a huge tax write-off. Repair costs, bonus depreciation, pass-through deductions, travel, home office. There's so many things you can deduct to really lower your tax bill. And then there's been a lot of concern. Well, is Biden going to change these things? It's possible. It's possible that we may see some changes in the 1031 exchange and so forth, but we haven't seen it yet. And it's pretty difficult to get these kind of changes through the House and the Senate. It's pretty tough. And especially when there's going to be a hot election in about another year. So there'll probably be some changes, but I'm not sure it will really affect the benefits that we get. So in summary, it's really been a perfect storm for real estate investors, except that, of course, it's getting harder and harder to get in because prices are going up, but not everywhere. There's still opportunity. So that's important to know. Are you going to go buy $120,000 brand new home like I did 15 years ago or 16 years ago in Rockwall, Texas? No, you're not. Those homes are $400,000 or $500,000 now. But you might find other parts of Texas where you can still get that kind of amazing return that I got 16 years ago. Are you going to be able to go right in the center of Tampa and buy a $40,000 home like we were in 2009? No, of course not. But are you going to be able to go to the outskirts and find a $150,000 home that rents for $1,500? And yes, there's still opportunity. The question, again, that people have is a bigger storm coming, and I'll talk about it at the end. But I really want to go over some of the fundamentals that are in place right now. Will we see interest rates rise? If interest rates went up a lot, we would most definitely see a slowdown in this housing boom. But you can see here that all these analysts and experts really don't think so. Some think that rates might go up a little, but not so much that it would really rock the house. So 4% there, let's see, 3%. Len Kiefer doesn't think it will at all. So differing opinions on whether rates will go up or down, but it really, the consensus is they wouldn't probably go up over 5% and probably not for a while. So would home prices decline? Well, you can see that they were rising even during one of the steepest and fastest recessions that we've ever seen over 2020. We saw home prices go up. I mean, that's incredible, right? And that speaks a bit to the solid homeowners that we have now, the solid buyers, and many of them cash buyers who aren't even worried about, they just want a place to live. They weren't even worried about a payment, or they needed a safe place to go. And because there was not enough inventory, they were willing to pay whatever they needed to pay to get what they wanted. And then, like I said, every area is different. So certainly some areas were more and less affected than others. You can see on here that certain cities that had tighter regulations have been had a harder time with unemployment. Los Angeles being at the top, that's where I live. And we had some really strict restrictions, why we're seeing our governor being recalled. And it's really affected unemployment. Las Vegas, big tourist city, of course, was very effective. Is the process of hiring back, but with all these concerns and headlines, it's tougher. New York on the comeback, but still at the top of the list of high unemployment. You can just again see that list. You go over to the lowest unemployment, you've got Salt Lake City at the top. Raleigh, Indianapolis, Minneapolis, Atlanta, you see the list there, Jacksonville, Cincinnati. These are areas that maybe didn't have as tight of restrictions over the past year and really experienced some steady job growth, or it was a more affordable place for companies to go. And a lot of businesses realized, wow, we need to go to places that are more business friendly, given what happened in 2020. If they wanted to operate, they needed to be somewhere else. So we're just seeing really strong employment in that section on the right. And these are areas where, again, if you've got jobs, you've got population, and you still have relative affordability in most of these areas. I don't see any places on that list that, except for Austin, that are traditionally expensive versus Los Angeles, that we all know is very expensive, and New York and parts of Chicago, Riverside, San Diego. All right. And then we've got this element of work from home and work part-time from home. And this has been a graph we've been following, and Zonda provides this every month. And it's been really interesting to follow that even in areas where maybe prices have gone up, like again, if you go into the middle of Sacramento or the middle of Jacksonville, it's going to be much more expensive. But if you just go to the outskirts, it's not as bad. So 6 months ago, we saw people kind of moving out of the cities and wanting more space. And then you kind of look at the chart to the right, and you see a longer list on the people moving 25 miles and more out, because in those suburbs, that maybe weren't as popular before because it was more cool to live in the city and there was more things to do and so forth, so forth. Well, now the thing to do is to be safe at home. I mean, I think people are still kind of freaked out a little bit. A lot of people are about the variants and so forth. So the ability to be able to be home more and also go into the office if you need to, but it's only a half an hour away and maybe you only have to do it 1 to 2 times a week. This has become a very popular thing, and it's really expanding those outer areas where there may be room for growth because they haven't peaked yet, but they're growing quickly. So when we really understand the trends and the demographics, this is where we can still harness some of that equity growth and cash flow over the coming year. You can see just over the past year, price appreciation for this reason. But look at the top, Los Angeles still at the top. Isn't that amazing? Even with just massive job issues, Los Angeles is still seeing massive price appreciation. But look at the other places that have too, that were also cash flowing. You know, you can see the list: Atlanta, Dallas, Houston, Orlando, Tampa, Indianapolis. These are all cash flow markets that also had great appreciation. And to me, that's just a better play. Unless you want to take the risk and get that big appreciation, it'd be more speculative. And you know, the Los Angeles, Seattle, you know, Riverside, Sacramento markets, those are, in my opinion, more speculative because anything, you know, higher interest rates would affect that. But in the meantime, those who did speculate, I think, made the right bet over the past year. But those of us who didn't speculate as much and went into the cash flow markets, we got the cash flow and the appreciation, and that's great too. Entry-level price change, Sacramento's seen the highest. You can see it's across the board, really strong price appreciation in the entry level. So what is driving this? Like I said, it is demand, population growth and demand. 5 million homes are needed, but the inventory of homes for sale was down 43% year over year, 43% at the end of May, representing 415,000 fewer homes for sale on a typical day in June. So again, like if there was 400,000 in foreclosures, it would be a welcome amount of inventory to help resolve this problem. Definitely not a foreclosure crisis by any means. There's the concern that we will never be able to provide enough inventory for demand. This article is saying, can we even build 2 million homes per year? The housing shortage is worse than ever and will take a decade of record construction to fix. According to this Forbes article, you'd have to build 2 million homes per year to make up for the homes that we didn't build over the last 10 years and for the housing boom that's about to happen. And then you've got this: new home lot supplies are down to just record lows, just not the lots out there for builders to even build. We do a lot of syndications. We buy land and build homes on them. And let me tell you, it takes sometimes 10 years to get to the point where you can build a home in certain areas. I mean, generally it's more like 2 years, but there's lots of delays and it takes a long time. So we're not going to see finished lots just appear overnight. It doesn't work that way. You've got to be able to get the utilities in and the roads and the water and all that, water rights. And, you know, people tell me, oh my gosh, I found land in Colorado. Should I buy it? And I'm like, make sure you can get utilities in there, and water being the biggest one. You can't do much if you can't get water in. So new home lots way down, that is not going to help this problem. And then add to it, the construction material shortages are delaying projects even further. We have 5 subdivisions we're trying to build, and you know, by the time we get our materials, it's months late. And then when you're finalizing the home and putting your appliances in, oftentimes parts of those appliances didn't come because they're backed up and there's shortages on those. So you might have got your washing machine, but it doesn't work because not all the parts are there. It's really hard to get your final and you know, you get your approvals. So it's been really tough for builders to get it done, and at a time when we really need to be building. Do we think that rents will decline then? And what we're seeing is same thing. If there's a shortage of housing, whether you're buying it or renting it, there's a shortage, and that drives prices up and rents up. Well, cash flows decrease. We are kind of seeing that at times where cash flows decrease because prices go up, but then we start to see rents go up and start to see it fluctuate. So you can see the last 2 months, it going back up. And the rent tracker, remember all the concerns about the eviction moratoriums. And while that was really difficult for a lot of landlords overall, rent collections were pretty normal. Again, that shows the demand, the strong demand for housing. Multifamily occupancy being at a 10-year high. So who are all these people? We'll address that in a minute. But you probably want to know where the rents are growing the fastest. We've got Tampa at the top of that list. Look at that red hot market. Tampa, that's been a market we've been in for 15 years. Very good market. At Real Wealth, we've been helping investors buy there before the housing meltdown and during it and after. And it's just all around been a great market. A lot there in Florida. And you just kind of go down the list and see even the blue areas like Bakersfield, California, only had 8%. That's still really good in rent growth. Not great for tenants though. And that's why you're going to hear more and more angry tenants, because can you imagine being a tenant and seeing rents go up 20%? It's a really tough time. We're going to probably see more inflation like this, and probably more angry tenants, which might be a good reason to be investing in areas that are landlord friendly, because it's often blamed on the landlord when, hey, our asset values are going up too. Okay, so rent growth equals cash flow, and we see here again the leaders in rent growth. Cities are coming back. There was a lot of concern that they wouldn't come back after the pandemic. I have a friend who just tried to buy an apartment, a unit in a condo, basically in New York City, and I was like, oh man, I bet you're getting a great deal there. It's like, nope, bidding wars on $5 million properties in little tiny condos in New York City. San Francisco thought, oh boy, this area is really hit hard. Nope, homes are selling like crazy and prices going up. So really, and the same is true for rents. It's coming back. It's coming back. You can see on that last quadrant, certainly these cities took a really major hit on rents during the pandemic and are on the comeback as things open up. And the rental share, you see that there's an increase in single family rental share. This is from John Burns Real Estate Consulting. And then single family renter household by age cohort, you can kind of see who's renting, and the biggest group being these 25 to 34-year-olds, and then 35 to 44. So sort of the Gen X, no, what am I trying to say? Millennials and Gen Xers are the big ones, but you've got renters and seniors too. Seniors are renting, and that's definitely growing. So again, why so much demand? Who are these people, and how did we not see it coming? The big question is, how did we not see it coming? Because this chart's been out for a while. We've known that the millennials are a really large group of people, 82 million, the largest generation, larger than the baby boomers right now. And then right behind them is 86 million Gen Zers. So there's just a lot of young people. And this group in here, the largest group of millennials, are about 3 years away from the typical home buying age. So 29 years old, this group in here. 31 is the typical home buyer age, but it's a little bit later now, 32, 33. But you can see this big wave of young people who are the most educated in history. They have the access to more information at the palm of their hands than our government had when I was their age. So they're just really well educated. Many are super tech savvy. They can work from anywhere. I, as a business owner, love having a company of millennials because they're tech savvy and they know what they're great they're great workers. Any kind of misnomer that they weren't is just plain wrong. So many of these people can live anywhere because they're tech savvy and they can work from home and they're educated. They're not necessarily the restaurant workers or the hotel workers that have to be on site. So although, there's plenty of millennials that are, but there's a lot who can live anywhere and have really high salaries. So again, that's why we're seeing massive price gains in areas that haven't seen that before, because it's not the locals living there. It's people with much bigger salaries moving in and being able to work in the guest room, right? So that's what we're seeing. And of course, I'm sure you already know that. And then the big thing to pay attention to is this money supply explosion, and more to come. with infrastructure bill, and now I think another $3 trillion bill that was presented. I mean, this is just fiat money at its worst, right? Just play money, monopoly money that is just keeps being printed. You know, if you give politicians the ability to print money, they will, and they are, and they love it, and it gives them votes. This is not necessarily something our forefathers wanted us to be able to do. That's why the Constitution doesn't allow the printing of money, but it does allow the borrowing of money. So the Federal Reserve prints it and the US government borrows it and we pay it back. But because it's increasing the money supply, that generally, historically, has created inflation. You can see the money supply really exploded starting in 1971 when we went off the gold standard and the US dollar became the new standard. And instead of gold, which is hard to create, you could just create paper. That's when it became super easy to print it. And now just digitally increase it by a 0 or 2. So this money supply explosion has created inflation in the past, and we expect that will continue. Because look at this chart compared to the one I just showed you. The money supply versus inflation looks pretty similar, doesn't it? I'm going to go back to the past one and look at the inflation, and you see the correlation. And like I said, we see more money coming. So, and it's unprecedented what was just done in 1 year. There's all kinds of conspiracy theories why that might be, that it was already in trouble. So why not just run it to the into the ground and print as much as you can while you can? I don't know. But it is, again, unprecedented to just print that much money in 1 year and then plan on doing more. It's not going to be good for people who don't own assets that also inflate, because if you're a renter, it's definitely going to be harder. So that just begs the question, where will prices be in 20 years? When you look at 2002, the median home price was $187,000. It would have been really hard to convince anybody, pull someone off the street, even an expert in real estate, and say, do you think prices will go up to, will double, by 2020? And people might say yes, they might say no, I don't know, but it's really hard in the moment to even comprehend dollars like that. I remember when I was living in Northern California, and I think Marin was the first place in the country to have $1 million average home price. And it was just like, what? Now that is becoming more common in more and more places, again, because of this inflation. And so you look at it today, here we are with a median price of around $350. Can you comprehend $700,000 median home price? It's hard. It's hard because you can't imagine even trying to afford that, or the average person trying to afford that. But based on history, that very well could happen in 15 years or less, based on, the money manipulation. So coming back to economic risk, is there a risk of a housing bubble burst? I don't personally see it, but I do see continued inflation and kind of bursting of the dollar, basically, like the value of the dollar just going down and down, which basically means you need more dollars to buy the same thing, which is inflation. So that kind of means asset values mostly rise because you're going to need more dollars to buy the same thing. Same thing for rents, interest rates. Will they rise? Not probably too much, but they probably will a little. If interest rates went up too much, it would really blow up the whole system and there'd be a new currency or something. I mean, who knows if they got, I've heard digital currencies. I've heard all kinds of things that would happen, and we don't know. But what we know is if they raise interest rates too high, the federal government simply won't be able to pay any of its debt, and it would be really tough, really tough. So the biggest concern is that people who don't own assets are really going to get left behind, be paying more for rent, be paying more for things, and not have a hedge against it. Whereas we know that when you can lock in low interest rates and buy assets that grow with inflation, you're really kind of getting the double edge there, where your debt is diminishing as those dollars become less valuable, but the properties are getting more valuable, your rents are going up, you have more cash flow. So the rich will get richer and the poor will get poorer. That's the risk. And that's why at my company, we're on a mission to help as many people understand this and do whatever it takes to just get your first property and don't sit around waiting for a market crash. I just don't see it. All right. So I am done with this and I can take questions. I'll stop the share. There. Let's see. I see a queue. Can we get a copy of the slides? Yes, of course. I can just send them over to Blair. And if there's not any more questions, then I'll just let you know that at Real Wealth Network, we have free membership, like 500 free webinars that help you dive much deeper into these topics, and a referral to different companies across the country that can help you acquire rental properties with management in place. And I also want to say that Think Realty has always offered really, really high quality education. I've always been extremely impressed with their conferences, and I hope you're enjoying their content, and I'm really honored to have been here. Let me
Thanks
see,
so
there's a
much.
chat.
Yeah, there's a couple of questions in chat right now.
Okay. What areas in Texas do you see as good value investment places? It really depends on which part of Texas, but if you can get cash flow, in my opinion, you got a good deal. We've been going more on the outskirts of Dallas, 45-minute drive. Still prices are going up, but we do have some connections that help us with that. Fort Worth has certain pockets that are up and coming. If you get a really good agent, you can find some deals. Florida and Texas really are still the fastest growing areas. If you want to get out of the limelight, so to speak, because there's a lot of investor dollars going in those places, you can get into the Carolinas or into Georgia. Anywhere in the Southeast is really the fastest growing part of the country. And if you really stop and think about where would a millennial want to live, raise their kids, kind of be near an airport or by close enough to be able to get to work if they have to go in 1 or 2 days a week, but has the things that they might want, which would be activities, some kind of cute downtown or something like that. So that's what we're seeing. We're seeing kind of across the board. Do I recommend investing in multifamily or single family or vice versa? I really thought multifamily was going to get hit hard during this past recession. I was really worried for my multifamily friends. We were seeing single family just be really popular, and people getting out of multifamily into single family to have the space and have their own air and not run into people or share elevators or anything like that, because the pandemic was really scary. And then all of a sudden we saw a reversal, and I'm finding out that my multifamily friends were doing just fine. In fact, if anything, doing really well, because there's so much money coming in, flooding markets. When the government prints that much money, it often lands in real estate and stocks. And that's why we're seeing it go there. People, making all this money, they make all this money in stocks. They're going to buy more stocks. They're going to buy more real estate. So I think multifamily is harder and more complicated, and you better understand it, because more is at stake. You have a bigger loan, you have more to deal with. Single family is fairly easy to understand. So it's a great place to start. I know some of my multifamily friends might disagree with me, but I personally think, hey, you can get up to 10 loans through Fannie and Freddie that are these low fixed rate, 30-year fixed rate loans. Go max those out. Get all 10, buy 10 homes. If you've got a spouse who's also working, get 20, lock those in, get really good quality homes in good growing areas. I like newer homes or fully renovated. And then you can do multifamily. And then you've got a track record. And when I say multifamily, I mean, I'm talking like 1 to 4 units. You can max out your 20 loans. So if you got, between you and your spouse, 10 each, and you got, say, 4plexes, that's a lot of units, so you could call that multifamily. If you really don't have the time to manage a multifamily or a single family portfolio, invest in someone else's deal. Just do a syndication with someone who has a track record in multifamily, because they'll do all the work for you and you invest, but you still get the tax write-offs, and you get, you share the profits and the cash flow. But if they have a preferred return, you get the cash flow first. Out of the profits, they get what's left over, and they're doing the work. So if you're busy, let someone else do the work, and don't try to have a toe in lots of things and fail at all of it. Right. So That's my thought. I just think personally 1 to 4 units is easier for me to understand, but yeah. Okay. Room room rater would rate your room 10/10. Thank you. You're welcome for the presentation. I am so always honored to be networking with the Think Realty people, and really appreciate y'all taking the time. So I'll send over the slides, and then I'll be having some really good high level housing economists on the Real Wealth Show coming up in the next couple of weeks. So you might want to tune in there too to get their opinion on where things are headed with interest rates and home prices and so forth, because I get a lot of my information. I get all my information from them. I would never want to pretend like I'm an economist or know these things. I just interview a lot of people. All right. Thanks,
Thanks so
Blair.
much, Kathy. We appreciate it. Great presentation. Lots of great information.
Thank you so much. Thanks for having me.
Have a good one. Thanks.
Take care. Bye-bye.